Hey everyone, it's Boyan with BK Securities. Today we're tackling a tough but important topic: how to recover from large trading losses. We've all been there. Losses can be a heavy blow, but they're also a crucial part of your learning process and trading journey. The big shift that you need to make in your mindset needs to be around the fact that trading is not a get rich quick scheme. Rather, you need to see trading as a business, no different than any other business out there. And the way I see it is it's a certain type of entrepreneurship where you're basically running a one person business. With that being said, it is unreasonable to expect a profitable business to have no overhead or any sort of expense. In the line of trading, capital is your business inventory. Just like a retail store has all the inventory, that they try to sell on their shelves. You likely also have some fixed expenses with this business, like your charting software, maybe some market data subscriptions, and so forth. So you need to see your losses as cost of goods sold, so to speak, as an expense. The good part is that at least these expenses will provide you with valuable learning lessons. I'll tell you a little bit of a story. When I first started trading years ago, I basically blew up my first trading account. Luckily, I put a very small sum of money in there, but I was very impatient to get started and I did not know anything at that time, right? In order to compete in the markets. I was just attracted to the lure of the stock market. This is when I was much younger, right? And then what I did is I went back to the drawing board. I properly educated myself. I took many courses, read many books, practiced on a demo account for a while, and then I attempted, everything all over again. This time, I had some large losses when the markets got volatile and experienced a 50% drawdown in my portfolio. But I was determined to win. I had to make this work for me. So I started using the strategy I'm going to go over in this video, and I managed to get the entire 50% that I lost back. So I was at zero. Then things started rapidly clicking for me, and I ended up plus 79% that year ROI. What a comeback, right? So going from minus 50 all the way to plus 79. And since then, I never looked back. Now I'm essentially a full-time proprietary trader and investor. So in this video, I'll share my strategies to help you bounce back stronger and more resilient than ever. Stick around because I'm going to show you my capital recovery trading system. Let's dive into the important stuff. So the capital recovery trading system consists of three elements and their set of rules, as we can see here. The first one is risk and account management, essentially your trading plan. The second is psychology and emotions. These are the things that I believe lead to most mistakes made by the traders, and they're responsible for most of the losses once you know what you're doing in the markets. Finally, the third component is continuous learning. This is very important and often overlooked. This gives you an edge in a zero-sum game that is the stock market because you're competing with others, right? Essentially, the objective is to make my trading system profitable each week and month and focus on statistical edge and the RR ratio. So what does that statement mean? What I mean by that is I want to have a consistently profitable business machine with dependable income and profits made every week, every month. I also want to have a statistical edge, just like casinos do, for example. They know that the odds and numbers are in their favor due to the statistical edge created across all of their games, right? And they know that in the long run, they will always win. Hence the saying, the house always wins, right? And finally, the proper RR ratio will allow me to build this machine where I can put $1 in and I can get back $2 or $3, right? Once you have that machine, then you overload the machine, okay? Let's look at each one of them. Okay, so the first element, right, and the first set of rules comes from risk and account management. Okay, and so you can see here I have 7 rules that I implement as essentially an emergency protocol once I activate my capital recovery system. And so you can see the 7 of them here. So let's go through them. The first one is start with half the initial capital. Okay, so when I have a losing period or large losses, I start the next account deposit with half of the initial capital. So if I started with $10,000 the first time, now I'm going to start with $5,000, right? This helps me manage risk better and avoid over leveraging, right? So right off the bat, you're taking 50% of the potential losses off the table so you can work on your system. Rule number 2, reduce your 1R. And you probably heard me talk about this in my other videos and in some of my courses. Okay, usually, a very conservative way to trade that I found works best is to have your 1R be 1% of your whole capital. What I mean by that, just as a refresher, so if I am risking 1R per trade, okay, my maximum loss is 1 unit of risk, right? And that unit of risk happens to be 1% of my total capital, right? That means that if I had an account with $10,000 in it, right, the 1% of $10,000 would be $100, okay? This means that on any given trade that I take in the stock market, okay, I will risk a maximum of $100 if I'm wrong. Now, the reason this is very conservative is because $10,000 represents 100%. So if we lose 1% per wrong trade, that means that we have to be wrong 100 times in a row. That is very unlikely. So it's a very conservative way to create consistent income in the markets. So with this rule, what I'm saying is I would reduce my R to 0.5% or even 0.25% of my net liquidation value of your total capital, right? And I would adjust it each week, this amount, right? This whole idea is that this lowers my exposure, right, in the markets for my capital and helps me stay conservative while rebuilding my portfolio and my strategies. Right? So what this means then is that if your 1R would be reduced to, for example, 0.5%, this means that if I had a $10,000 account, my maximum loss per wrong trade would be $50, right? Now I can be wrong 200 times in a row. So even more unlikely, right? If you're wrong on 200 trades in a row, you shouldn't be trading. Okay. All right. Rule number 3, focus on ATR and stop losses. I focus heavily on the average true range indicator, right? And stop losses more than on my potential profits on any given trade. Okay. So it's almost like playing defense first, right? This ensures that I manage my risk effectively and avoid significant drawdowns in my portfolio in the first place. What do I mean by this? All right, you can see here that we're looking at a chart of Meta and we're looking at daily candles. When it comes to the idea of focusing on ATR indicator, okay, and stop losses more than profits, if you recall from my previous video on how I set those stop losses and profit targets, I talk about adding that ATR indicator, and you can see the ATR indicator on the bottom of the screen here. Okay, this red line that's running through. And if you remember, if you go into whatever charting platform or broker station that you use, if you go into indicators, right, and search up average true range, you can just simply add it onto your charts. And so once you add it onto your charts at any given time, you'll notice that when I highlight this red line here, right, it will tell me on the left side there, particularly right here, right? It will tell me right there what the ATR of the last candle is. And average true range, right, is the distance between right, the low and the high of the candle, right? So the movement within that day. So what I mean by that is when I'm entering a position, right? Let's pretend like we're going to go long on Meta here. We're thinking it's going to go up, right? So if we enter a position on Meta right there, okay, at 517.77, my ATR should be at least 20.03 cents. So let's say $20. I need to move this particular stop loss here, to roughly about 20 bucks, okay? Let's say right there to 497.36, okay? The ATR is telling me that next day could move that much of a distance. So I need to make sure I don't get into a situation where I'm going to get stomped out of my trade quickly and then the thing reverses and flies up. So I'm focusing on doing this first. Once I do this, my big thing is to make sure I don't buy too many shares or go outside of my max loss, right? So if you guys remember, someone has that $10,000 account and they are, they lower their 1R to 0.5%, which means they have a max loss of $50 on their account. Okay, based on this particular ATR of 20, this means that the maximum amount of shares that you can buy and still maximum loss parameters, your protection, is $50 divided by the ATR of 20, which gives you a maximum of 2 shares, right? You can't buy 3 because then you would be at 60. Now, if your R was the regular 1%, right, and you had the $100 as a max loss, this means that the maximum amount of shares that you can buy is 5 shares. This is an important thing to understand. And when you have series of losses, you need to lower that R to that 0.5% until you get back on your feet and you realize where your mistakes were and you can adjust your strategies. So we'll be back at the meta chart, and that leads us to rule number 4. Make your trades risk-free, right? So this is an awesome concept because at some point you have no risk on your trade anymore. Okay, and how I do that? So once a position hits plus 1/2 of R or 1R, I shift my stop loss to the entry price. Once I shift my stop loss to the entry price, I cannot lose money on that trade anymore. At worst case, I'll be at break even at $0. Okay, so I make it a risk-free trade. This protects my capital and locks in the gains. I often, as I'm hitting higher and higher profits and increasing it by R kind of thing, I tend to shift my stop loss up, right? And I lock in my profits all the way to the target. And if the stock violently reverses down, right, I locked in my profits and I'm not going to be at 0 or in a negative. Okay, so that's another crucial concept, right? So looking at this on a chart, so our 1R is based on the units of ATR, right? So once the stock, if we entered here, right, at the 517.77, right, once the stock moves $20 higher, 137.77, right, somewhere around right there, okay, once the price of Meta moves there, I'm going to shift my stop loss up there. And you can see now that I have a risk-free trade. Okay, so if this price hits and comes back down, I'm not going to lose any money. Okay, but I'm giving it I'm giving unlimited profit capability, right? So, and then what I meant earlier as well is that if I shrink that, and let's say Meta keeps going and going and going and going, okay, and it gets from this 537, okay, another $20. So it goes to 557.77 around that area. Now I'm gonna take the stop loss from the entry price and shift it up to this red line. Okay, so now that will be my stop loss, right? So you can see that from the entry price, we have actually locked all of this profit here. Okay, so it's locked in. If it comes back, hits it, we for sure made money on a trade. How much? It would depend how far Meta goes, right? So now if it moves another, 20 bucks, let's say it goes to like, whatever the number, 580, call it, okay? I'm gonna take this red line, which is my stop loss, and shift it up to 557. So now I've locked in this much profit, and so we go, right? And so that way I can maximize my profitability on any given trade and minimize my capital exposure. Okay, so that's what I mean when I say make trades risk-free. The other thing to understand is we need to be selective with our trades, right? And I'm more selective on what trades I take, right? Because I don't just take trades just because they kind of look like, they have one signal or something like that. No, at this point, quality over quantity helps reduce the risk of any further losses, right? So look for trades where there's areas of confluence, meaning that there's like large key pivotal points that have several, maybe there's a horizontal support along with the moving average and another indicator, and you're getting multiple signs kind of thing, right? Only then do you take the trade. Okay, so that's what I mean by being more selective. Another thing is, rule number 6 that I implement is limit risk exposure as a whole to your account. Okay, so at any given time, the amount of open trades that you have, right, in total should not exceed 5 to 10% of your entire capital value. And a lot of people get burned here, right? When they get greedy, they risk they take 30 trades at once and take up 50% of their capital, and some of those are risky trades, right? Then if the market all of a sudden switches overnight, right, which is what we saw recently here, suddenly all of those trades are in a negative. Whether they were a good idea or not is irrelevant because the whole market's down basically, right? So now you have these massive losing positions and stuff like that. So I would only risk 5 to 10% at any given time when you're in your capital recovery system. And so this prevents any single trade from having a catastrophic impact on, my portfolio or your portfolio. What this means is that, again, if I have $10,000 in my account, right? And let's say at any given time, 10% is my max risk, right? For all of my trades across all of my portfolio. Right? This means that if my 1R, right, is 1%, for example, right, that means that I can only have, right, at any given time, maximum of 10 trades, right, or 10R as an exposure, right? Because this here is kind of the idea behind, sticking and limiting your exposure. Right? So at any given time, if all your trades went south, you would lose 10R or 10%. Okay, hopefully that never happens to you, but you can even go down to 5. Okay, and then as you close some trades, only then can you reopen new trades. And the last rule, which is really important, is number 7. I keep a detailed journal. With all my mental notes, with everything that I'm seeing, right? So I keep a detailed trading journal to track my trades, decisions, and outcomes. So I can look back and quickly improve. Like the whole goal is to improve quickly. On every trade, you need to learn something and improve. Okay, this helps me analyze my performance and identify areas for improvement. Right. So these are the risk and account management set of rules that I implement with my capital recovery trading system. All right, so now we're moving on to the second element of the capital recovery trading system, which is the whole idea of psychology and emotions, right? So the first important thing is building emotional resilience. Okay, and so remember that setbacks are a part of the trading journey, right? Developing resilience will help you handle, right, further losses, right, and keep you focused on your long-term goals, right? That's kind of the idea of the next strategy. So what do I mean here? You can't have the emotions impact you while you're trading, okay? That's why we need to risk a proper amount of money. That's why we need to do all sorts of things so that way we don't let emotions like fear and greed come and take over, because this is emotional resilience is how we control fear and greed. And what we need to realize is that markets, right, they don't move in straight lines like so. Okay, instead they move in waves, right? There's a wave up, then wave down, then wave up, then wave down, then wave up, and so forth, right? So you have to expect these portions, right, of your journey where there is going to be a period of down before another massive wave up, right? So this is how they move when they're bullish, right? When markets are bearish, right, they move on the way down where there's a wave down, then a small wave up, then a large wave down, then a small wave up, and so forth, right? So markets move in waves. So you have to expect the waves, and you need to adjust your trading based on these waves. And again, it is unreasonable to think that your trading business is going to have zero, costs or zero expenses. Like it's unreasonable for any business. See these losses as learning lessons and cost of doing business, right? The important thing to know is that as long as you control your RR ratio, where you kind of risk that $1 to get $2 or $3, right? And you're more selective, and you do everything I showed you in the risk and account management portion of the strategy, right? Over time, the stats and mathematics will kick in, and just like a casino, you will make money. So over time, you will make money, okay? Because your trading probably will go in waves as well. Another thing that I found helpful, okay, when it comes to psychology and emotions is sometimes you just need to take a break, right? So sometimes stepping away from the market can give you the mental clarity, right, you need, and you can use this time to reflect and recharge. More importantly, maybe you are not reading markets right at the time. Maybe there is, other stuff going on in your life, right? Sometimes people get chart exhaustion, where every chart you look at, it seems the same, right? I know for me, when I have other big things that are happening in my life and that are impacting me negatively, I'm not 100% focused on trading, and I'm competing with these people who that's all they do, right? Just like me. So if you kind of take your eye off the ball, right, the game changes rapidly for you, usually down to the negative side, right? So this is why you should sometimes, if you need to take a break, especially if you're not 100% and you're not kind of living and breathing trading, because there's a lot of talented people trying to do this. And sometimes it's good to take a step back, right? So you can evaluate kind of whether you're looking at the markets objectively, whether you got the right idea on what's actually happening in the markets. Another thing that can be super helpful is, seeking support. Don't hesitate to talk to your trading community or mentors, right? Share your experiences and get advice, right? That's super helpful. When I think of seeking support, I'm not saying go out there and beg people to help you and stuff like that. I just mean, it's a way for someone to check your work, so to speak, where, get someone else who does this also to take a peek at what you're doing, get a different perspective. Maybe that will open up your mind to different possibilities and maybe point out what you're doing wrong. I know, criticizing yourself is the hardest thing you can do. And then, when you're a part of communities and stuff like that, you also hear kind of other trader stories and what they're dealing with. So maybe your situation isn't that bad, or if it is that bad, maybe you can hear their stories about how they overcame that, right? Just like I'm showing you this strategy, because again, we all have these types of times. It's not, no one's always winning in the stock market. So another important tactic, right, is to engage in stress relief activities, right? So activities like exercise, mediation, spending time with loved ones, right? Like all these things can help alleviate stress and improve your emotional well-being, which is what, like I told you, emotions and psychology is, one of the things that causes the most losses over time for new traders, because impact of seeing your capital go up and down with those waves can be extremely stressful, right? And if you don't know how to deal with it, it just gets worse and worse kind of thing, right? So and then what happens is you make stressful decisions, which are often the wrong ones. And this is usually when you break your trading plan, which is usually when things go south. I know, as an example, for me, when it comes to stress relief, in terms of exercise, I've essentially joined, like I have a soccer team that I play with every week a couple of times, right? So that's one way I get exercise and kind of just something else happening, right? Watch some good shows, maybe take a break on, go for walks, do whatever you want to do to kind of relax your mind, or simply spend time with your loved ones, right? So next we move on to the third and final element of the capital recovery trading system, right? Which is continuous learning. And again, this is often very kind of overlooked, okay, but really important. The first step that I implement is meticulously reviewing my trades. So start by reviewing your trades to understand what went wrong. Okay, this is very important. Understanding what went wrong is going to help you figure out how to make it better, right? So you don't make the same mistakes. And usually I find that it goes wrong in three ways, right? So was it, one, a flawed strategy, doesn't generate good returns and minimize risk, right? Was it poor risk management? right? Did you forget to set your stop loss? Did you buy too many shares or too many of whatever securities you're trading, and then the loss was bigger than your max loss, right? Or was it emotional decision making, right? Were you looking at the chart being like, oh, I don't want to lose money, right? So you kind of like set too tight of a stop loss and lost money just before the markets flew up, right? Or maybe your position has been profitable and running the entire time, right? And you're, hey, like I don't want to, I want to lock in my capital. I don't want to forego profits. So you exit early. So later on, it happens that, the stock kept on going another like X amount of percentage, which would have doubled your profits, right? That happens all the time, right? So usually it's one of the three things. So identifying your mistakes, right, is the first step to like learning from them, right, and being able to improve and not make the same ones. Next thing that I do is I try to learn new strategies, okay? And this is really important because expanding your trading toolkit, right, by learning new strategies and taking online courses, right, reading trading books, following successful traders and hearing, their insights and what they're thinking, right? These are all important things. And the reason knowing and learning new strategies is important is because again, you're competing with others. Like trading is, like a professional sporting environment. Everyone's trying to get better every single day. So if you're not, you're just going to kind of stay behind, right? And then you will be competing with people that are way better than you at this. So constant improvement and advancement is crucial, right, in your performance and in your general trading journey because of that zero sum gain, right? Sometimes I see trading like golf, right? You never really get perfect, but it's a never ending learning. To give you guys an idea, with my educational journey, I don't even know how many courses that cost me, I spent over $150,000 on these courses, all of them together, right, for my education. I don't know how many hours I put together, into reading books and making notes and all of that. Like you're constantly trying to improve, you're constantly trying to get better. So another big thing, right, so for learning is expanding your sphere of knowledge. Okay, so don't limit yourself just to trading strategies or like one particular instrument, right? Like learn about market psychology, learn about different indicators, learn about events that can impact the market, right? I'm not saying go and follow news or something like that. Just learn about everything that you can, so you can kind of see the idea for yourself. It will help you spot ideas before others do, which is the way you make money, right? You get into a position before everyone else does. So once they do, they drive, the price in your desired direction and create profit for you, right? That's the name of the game. We talked about new strategies, right? Like, because not every strategy will work through, at all times in a stock market all year round for years and years and years and years. Okay. Why? Well, because we know that markets have three ways of movement, right? They have the bullish market, right? Which is defined with making higher highs and higher lows, basically. So we can see that prices are constantly going wave up, right? We're increasing. Then we have markets like we talked about when they're bearish markets, right? When they're mostly going down with those small spikes up. So they usually make lower highs and lower lows, right? And then the third way of markets is sideways movement, right? Consolidation, when they're making the same highs and same lows, right? So these are the three trends that we normally see in the market. Right? And so we have to be prepared for all of them. One strategy that you might use might not work on, one of the three scenarios, or or two out of the three, or whatever. So you have to know strategies that will make you profitable in all three of the markets, right? That's one of the big benefits of trading. You can profit in all directions. Investors can only profit if it goes up, right? Investing is only profiting through here, but they don't have, these options usually. So that's why, as a trader, you need to understand these three and how to profit from each of them in the market, no matter what it is. And because no strategy works forever in a market, it's good to have several trading strategies in your arsenal, so to speak. Okay, and then what I would do is also maybe learn more than one security type for trading, right? Maybe you start learning which stocks, then you move, learn about options, and you learn about forex. Like these are ways to diversify, right? Because how often do you hear in the news when stocks are doing bad but bonds are doing great, right, or something along the lines of that? So you can find areas where you can hide and make your profits during any market, right? That's kind of the idea of this portion. And finally, when it comes to continuous learning, we need to analyze and learn from losses. Okay, so every loss teaches you something valuable. Use these lessons to refine your strategies and improve your trading decisions. This is the best part about, these types of losses from trading. They're educational, so to speak, right? At least when you lose money in the market, you learn something. It's like paying for forced education. That's how I see it. It's basically forced education, maybe a cost of doing business. After you're losing trades, right, test the three main things, right? Like, what's the reason you lost, right? Was it emotions? Was it not following your trading plan? Like, what was it? The idea is to spot your mistake, right? I know I can certainly do it most of the time for me now. So every time I make a mistake, I'm quick to kind of patch up and never do that again, so to speak, or as best as possible. And finally, I want to talk about the idea of, demo trading or paper trading accounts, right? The idea of these is you also don't need to use real capital if you choose not to, right? Because sometimes real capital can get you emotional and stuff like that. So it's might be easier to learn in this environment. Okay, so also demo trading accounts are more favorable for new traders to start, right? And this gives you an ability to practice strategies and concepts in the environment before exposing your real capital to risk, right? Essentially, it helps you gain confidence and refine your strategies without the pressure of real money on the line, right? Because the hardest thing to control in trading is emotions, right? That's one of the biggest issues, and the psychology that comes with it, right? So it's hard to learn and test, your capital without getting emotional when you see red or losses, right? Or it's hard to not get greedy when you see you're just crushing it and killing it. You're like, oh, I just want to feed the machine with as many dollars as possible, right? The demo environment, right, gives you that confidence in your trading system. So when the real capital gets traded, you kind of know how it will go and you know what to expect, and it allows you to deal with losses better because they'll be expected. They'll be the norm, right? You'll be expecting a certain percentage of your trades to lose, right? And the good thing is that most charting platforms and most broker platforms, open these types of paper accounts or demo trading accounts for completely free. So it doesn't really cost you anything. Gives you live market data. Everything is the same as in a real market, except for you're not trading your real money. You're trading, imaginal money, because when one of these accounts get opened up, you start with like 100K, for example, right? And then you see what happens from there. Only after I'm successful in creating, profits for weeks or months, at least 1 month, for 4 or 5 weeks, only then will I raise my R back to 1% or put more money in or something like that. So I hope this was helpful for you guys. I hope you enjoyed and understood the capital recovery trading system and its three elements. Okay. If this was helpful, like, subscribe, comment, and of course follow the channel, so that way you can get notifications once I release new videos. All right. Thanks for watching. We'll see you in the next one.